If you put $500 into Bitcoin ETFs last year because every finance influencer told you to, you lost money. Meanwhile, a completely different sector turned that same $500 into $1,100 in just 12 months. This chart plots the verified 12-month trailing returns of major assets as of April 2026. You can see the broad U.S. market flatlining at 4%, the hyped crypto line dropping 16%, and right above it, a hardware sector line going completely parabolic. The asset allocation rules that felt entirely safe in the 2020s are now dead weight in your portfolio. You're likely feeling stuck. The investments plastered all over financial media are underperforming, while sectors completely ignored by the mainstream are quietly posting triple-digit returns. We are going to ignore the hype cycles. I've broken down the live market data to identify 5 structural macroeconomic shifts and exactly which ETFs are positioned to capture them. Escaping the stagnation of the next decade requires trading the false comfort of popular consensus for targeted, mathematically rigorous sector allocation. The most extreme number in the entire dataset is the semiconductor sector, tracked by SMH. It just returned 130% in a single year, driven by an unavoidable global hardware monopoly. Software AI requires billions of physical chips. The 4 largest tech companies on Earth are currently creating a multi-year order backlog for compute infrastructure. They all need the exact same hardware at the exact same time. The trade-off here is severe short-term volatility. This is an exponential growth engine, but with indicators running hot, you have to size in gradually and resist the urge to lump sum invest at the absolute peak. This scorecard breaks down the SMH evaluation. Its role is your high-volatility growth engine, driven entirely by the macro demand for compute infrastructure. Look next at clean energy, tracked by TAN and ICLN. Last year, analysts declared the sector finished because of high interest rates. Instead, it surged 98%. In early 2026, a massive supply shock took 9% of global oil consumption offline. Governments and institutions were immediately forced to pivot away from vulnerable transit choke points and prioritize domestic energy security. The trade-off with TAN is that its performance relies almost entirely on sovereign policy mandates and global crude prices, offering a near-zero dividend yield during market downturns. Looking at the clean energy scorecard, we slot this in as a geopolitical hedge. It carries medium to high volatility, driven by the sovereign shift toward energy independence. The explosive growth in both hardware and clean energy proves a clear point. Capital is rapidly migrating away from digital hypotheticals and into companies that produce physical necessities. This brings us to international equities like VXUS and EWT. For years, U.S. megacap tech concentration was a strength. Today, it is an extreme vulnerability, making non-U.S. markets a necessary antidote. Look specifically at Taiwan, tracked by EWT. It serves as the irreplaceable global factory underpinning the entire AI supply chain, making it a critical geographic allocation outside the U.S. The trade-off is straightforward. You escape the heavy concentration risk of the S&P 500, but you actively expose your portfolio to specific geopolitical flashpoints in Asia. This scorecard outlines the international equity play. It functions as a core portfolio anchor with low to medium volatility, capitalizing on deeply undervalued global fundamentals. Healthcare is next, and the data reveals 2 entirely different strategies operating under the same umbrella. If you mix them up, you will get burned. On one side, you have the defensive, dividend-yielding stability of legacy pharma, tracked by IXJ. On the other, you have ARKG, a highly speculative, long-duration bet on programmable medicine and genomics that regularly sees brutal 50% drawdowns. The trade-off requires building a barbell. You anchor the bulk of your healthcare exposure in IXJ and strictly cap your ARKG position at 2 to 3%, requiring the discipline to hold through catastrophic dips without panic selling. This split scorecard visualizes the barbell strategy. IXJ serves as your reliable defensive anchor, while ARKG acts as your extreme volatility satellite bet. Strategic portfolio construction pairs these reliable defensive anchors with capped high-risk satellite bets to ensure the entire allocation doesn't buckle during a sector correction. The final category is the inflation hedge, tracked by the gold miners ETF, GDX. While traditional equities and crypto dropped, GDX spiked 154%. When real-world crises hit physical supply chains and wars escalate, institutional capital does not flow into digital tokens. It aggressively flees to physical stores of value. You must respect the vital trade-off here. GDX has a near-zero long-term trendline return. It is a temporary circuit breaker, not a buy-and-hold forever asset. This scorecard evaluates GDX strictly as an active cyclical hedge. It carries high volatility and is driven directly by structural inflation. Your execution strategy requires strict boundaries. GDX should never exceed 5% of your portfolio. It is an active insurance policy that requires you to actively rebalance when the macroeconomic storms eventually clear. This flowchart maps the 10-year macro portfolio to your risk tolerance. Baseline investors seeking stability should swap stagnant U.S. indexes for international VXUS and defensive healthcare IXJ. Pragmatic optimizers build a barbell, SMH as your growth engine and GDX as your active insurance policy. Just as critical as what to buy is knowing what to avoid. The current institutional data clearly highlights what needs to be dropped from your allocation immediately. Avoid heavy allocations in broad S&P 500 funds and crypto ETFs. They carry severe concentration risks and failed as safe havens during recent market fractures. You should also hold off on heavy India-focused allocations right now. The long-term thesis is solid, but you need to wait for near-term equity market corrections and extreme volatility to stabilize. Don't just take my word for it. The raw verified data dashboard is linked below. Download it and check the institutional numbers for yourself, rather than blindly trusting financial influencers. Navigating the next 10 years requires a shift from popular consensus toward portfolio architecture built on these real-world data points.